Hello, this is Joe Hoyle speaking to you from Richmond, Virginia, where we're going to talk today about inventory. This is the second video lesson with inventory, and this is a very common question for companies that grow from small to large. Your uncle has an office supply company. He sells office supplies to customers who come in. When the company first began, they probably had a fairly small amount of inventory, and they could probably keep up with that fairly easily. They might be able to walk out into the showroom and simply see what needed to be bought and take care of it that way. But as companies grow, as companies get more inventory, suddenly they have a bigger need for keeping up with their inventory balances. Do we have enough of this? Do we have enough of that? Is there enough notebooks? Is there enough magic markers? We always have the question of having the right amount of inventory. You don't want a customer to come in who wants an inventory item that you don't have. So keeping the amounts up to date and sufficient is very helpful. So your uncle says, well, how do we do all of this? In accounting, there's really two basic ways to keep up with inventory. One is a periodic inventory system. And a periodic inventory system is typically what was used 40 or 50 years ago and is still used in fairly small operations. For example, if you go to a beautician who keeps hairspray, that probably is going to be kept by a periodic system. There really is no reason in a store like that to spend the money for a more elaborate system. But my guess is that your uncle has really outgrown a periodic system. In a periodic system, you do not keep up with the inventory at all. You can't look at the records and know how much inventory you have. When you buy inventory, you do keep up with the cost. How much did the purchases cost? How much did the transportation cost? How much was your cost? But you don't keep up with the amount of inventory. So if you walk into a store that uses periodic inventory and you say, how many notebooks do you have? Or how many canned hams do you have? The answer is, let's go look. Because you don't know without going out into the showroom and looking at the merchandise itself. So periodic systems cost virtually nothing, but they provide you with no information. And again, if it's a small store with very little inventory, that may very well be fine. Therefore, how do you actually produce financial statements in a periodic system? In a periodic system, you get to the end of the year, you need to know how much inventory you have, you go count it. You take a physical inventory, you count the inventory, and then you figure out the cost of those units, and that's what you report on your balance sheet as your ending inventory. You don't know until the end of the year, and you only determine by taking a physical count of the inventory. And if you want to know how much inventory you sold, you use the cost of goods sold formula. You take the beginning inventory, you add in all the costs that you had for purchases, and you subtract out the ending inventory to get cost of goods sold. I tell my own students that what that really computes is the cost of the goods that's missing from the store. Beginning inventory plus purchases minus ending inventory is the cost of the goods that are no longer there. And we make the assumption that those are the cost of goods that have been sold. Beginning inventory plus purchases less ending inventory. So a periodic system, what do we know? You don't keep a record. You don't know the amounts. You do keep up with the cost. But if someone says, how much inventory do you have? You simply don't know without looking. How do you produce financial statements? You count the inventory and then you compute cost of goods sold. What's the problem? Lack of information. But it's cheap. Most companies, especially today when computer systems are so much cheaper than they used to be, use what's called a perpetual inventory system. And a perpetual inventory system does keep up with the quantity of inventory. If you walk in and say, how many notebooks do you have? they punch in the computer and they say, we have 27. Or if you say, how many canned hams do you have? They look at their computer system and say 14. They will know the information. And then you can upgrade that in many ways to make more use of the information. When you have information, you can always find ways to make use of it. How does a perpetual system work? When you buy inventory to begin with, you add that to your inventory totals. You cannot keep updated balances without adding the inventory as it's bought. So if you buy some more notebooks, if you buy some more magic markers, you have to actually add those to the inventory. But computer systems and barcoding do that fairly easily. When you sell inventory, you take the inventory out. So if a customer walks in and says, I want to buy 5 notebooks, then you take those 5 notebooks out of your inventory and you move that cost into cost of goods sold. Not at the end of the year, but right when it happens. So if you look at the inventory records for either inventory or cost of goods sold in your computer system, you'll know exactly how much you have and how much you have sold. Much more information. Of course, the computer systems cost some money. But again, to be redundant on what I said before, computer systems are cheaper than they used to be. That's why so many companies use perpetual systems. Do you still take a physical inventory? Yes. Why? Because you know how much inventory you have. In a perpetual system, you take a physical count just to check the records. You're not really expecting to be off too much, but inventory can get broken, inventory can be lost, inventory can be stolen, errors can be made in the system. Things like that can happen. So you do have to take account, but it's only to make sure your records are reasonably okay. So what should you tell your uncle? He may want to start out with a cheap system, but if his company is going to grow, any at all, he might as well get as much information as he possibly can. Because he needs to know what is selling well, what is running short, what do you need to buy. He needs to manage his inventory very carefully to keep his customers coming back, knowing that they're going to be able to acquire what they want. We've looked here at inventory, and what we've looked at is how do you monitor your inventory, a periodic system or a perpetual system. Inevitably, if you're going to have much inventory, if you're going to grow, you're probably going to go for a perpetual system. This is Joe Hoyle. This is Richmond, Virginia. Have a great day.